Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive into something really powerful today. It's an investment philosophy called coffee can investing. And what's so fascinating about it is that it's designed to build some serious, long-term wealth by doing something that feels, well, completely wrong to most people. It's about doing less. It's about tuning out the noise, focusing on what actually matters, and most importantly, learning how to avoid the traps that sink so many investors. So let's get into it.
You know, this quote from the great Benjamin Graham, it just hits the nail on the head. It really sets the stage for everything we're going to talk about. Because he's saying the biggest risk in investing isn't a market crash, it's not a recession, it's us. It's our own emotions, our own impulses. I mean, think about it. Even Sir Isaac Newton, one of the smartest people who ever lived, lost an absolute fortune in the stock market. Why? Because he got caught up in the hype and panic of the crowd. It's just a perfect reminder that our own brain can be our biggest enemy.
So to really understand why a different approach is so necessary, we need to start with a story. It's a bit of a cautionary tale, really. And it's about a trap that so many people, maybe even you at some point, have fallen into. So let me introduce you to a guy we'll call Mr. Talwar. He's the kind of person we all know, right? He's done everything right in his career, great education, climbed the ladder at a big company, study promotions. He's 50, has a great family, but he's lying awake at night. Because after a quarter century of busting his tail and earning a good living, he feels completely unprepared for the future. And his story is a huge warning sign.
You know, the really striking thing about Mr. Talwar's story is just how familiar all his mistakes are. He wasn't a fool, he was just being human. He was trading stocks based on tips he heard at the office, churning his portfolio so often that his broker was probably the only one making any real money. He chased some high-interest loans to real estate developers and got burned. He put way too much into property thinking it was a sure thing, and then his money got stuck. Does any of this sound familiar? These are the absolute classic wealth-destroying behaviors.
And this chart, wow. This shows you the real, devastating costs of all that activity. Over 27 years, a time when the Indian stock market, the Sensex, was compounding at almost 16% a year, Mr. Talwar's entire portfolio scraped by with a measly 4%. Look at that gap. That's not just a few percentage points. That is the difference between a comfortable, stress-free retirement and that deep, gnawing anxiety he was feeling. The opportunity he lost is just staggering.
But look, Mr. Talwar's story isn't just here to scare us. It's actually the perfect setup for the solution we're going to unpack right now, the coffee can approach.
So what in the world is coffee can investing? Well, the name itself tells you pretty much everything you need to know. It comes from this old practice back in the American West. People would put their most valuable stuff, cash, gold nuggets, property deeds, into an old coffee can and literally hide it under the mattress for safekeeping, sometimes for years. The idea is to apply that exact same buy it and forget it mindset to a portfolio of truly fantastic companies. You do all the hard work up front to pick the right ones, and then you leave it alone for at least a decade. No checking, no tinkering, no trading.
And just so we're clear, this isn't some quirky, fringe idea. This is the absolute core philosophy of the most successful long-term investor in history, Warren Buffett. He's not trying to guess which way the market is headed. He's not jumping on the latest hot trend. He's focused on one thing and one thing only, owning pieces of exceptional businesses. And when he finds one, his favorite time to sell is never. That mindset is the absolute bedrock of this whole strategy.
Okay, that all sounds great in theory. Own outstanding businesses. But that just leads to the big question, right? How do you actually find these great companies? Well, the beauty of the coffee can method is that it's not based on gut feelings or hot tips. It relies on a very simple, very disciplined, data-driven process. Let's break down exactly how it works.
It all boils down to these two simple, non-negotiable rules. First, a company has to have grown its sales by at least 10% every single year for the last decade. Not on average, but every single year without fail. That shows you it's incredibly resilient and people keep wanting what it sells. Second, it has to have generated a return on capital employed, or ROCE, of at least 15%, and again, every single year. This proves the business isn't just getting bigger, it's growing efficiently and making real money. The thing is, companies that can clear both of these very high bars are exceptionally rare. They're built to last. Now, finding these companies, that's half the battle. But the other half, and frankly, the part where most people fail, is having the discipline to just hold on, to do nothing and let these incredible businesses do their thing. Let's look at the actual evidence. The results from testing this strategy are,
Well, they're just remarkable. Have a look at this. Whether you held one of these portfolios for 3, 5, or 10 years, the annualized returns have historically come in around a stunning 24%. Now compare that to the broader market, the Sensex, which was down in the low double digits. The consistency of these returns and the massive gap in performance, it's just undeniable.
Let's just boil all that down to one single powerful number. Get this. Over a 10-year period, this simple two-filter strategy has historically beaten the market by a median of almost 12% per year. Think about that. That kind of outperformance achieved by actively doing less, that's what makes this whole idea so revolutionary. It just flips everything we're taught about investing completely on its head.
So this really frames the choice every single one of us has to make as investors. Over on the left, you've got the path of constant activity. You're trading, you're paying fees, you're making emotional calls, and the only person getting rich for sure is your broker. On the right, you have the path of patience. You just let the incredible power of compounding do its magic, you let your best ideas grow, and you build real, long-term wealth. The choice seems obvious, but fighting that instinct to constantly do something is incredibly hard.
So let's bring all these ideas together, because what we've really been talking about here isn't just a tactic or a formula. It's a complete shift in mindset. You could even call it a new investing manifesto.
Here are the 3 core principles to really lock in. First, invest. Don't just punt. Think like you're buying a piece of an actual business, not just trading a ticker symbol on a screen. Second, you have to recognize that patience is your superpower. Resisting that urge to meddle is your greatest advantage in a world that is obsessed with short-term noise. And finally, number 3, prioritize quality above everything else. Don't get suckered in by a stock just because it looks cheap. A truly great business, even at a fair price, is almost always going to be the better bet in the long run.
So I'll just leave you with this one final thought. We all know that old saying, right? The best time to plant a tree was 20 years ago. The second best time is now. And that's true for investing too. The strategy is simple, the filters are clear, and the historical results are incredibly powerful. But the hard part isn't finding the great companies. The real challenge is you. Once you've planted those seeds, once you've built that portfolio, do you have the discipline, the conviction, and just the sheer patience to simply leave it alone? Answering that question for yourself is the ultimate test.
Do you know that feeling? You've done everything you were supposed to do. You got the good education, you climbed the corporate ladder, you've got a wonderful family. But when you look at your bank account, something just feels off, like you're running in place. Well, if that sounds familiar, this explainer is for you. We're going to walk through a story that is frankly a bit of a cautionary tale, but it's also packed with some powerful lessons. Man, that sentence just hits you, right? It perfectly sums up the guy at the heart of our story. On the outside, everything looked perfect. He'd achieved what so many of us strive for. But underneath all that success, there was this growing, gnawing anxiety about his money. So the big question is, how on earth did he end up there? All right, so here's how we're going to break this down. First, we'll meet our guy and take a look at the journey that led him astray, a path paved with what looked like safe decisions. Then we get to the really juicy part, the shocking reality check when the hard numbers came out. From there, we'll unpack the big lessons, the common traps to avoid, and a powerful strategy for making the final stretch of your career really, really count. Okay, let's dive in and meet our protagonist. His name is Mr. Yogesh Talwar, and this guy is smart. He's a highly educated engineer, got an MBA from a top-tier school, and walked right into a fantastic job with a multinational company way back in 1990. I mean, from the outside, his life was the absolute blueprint for success. Look at this timeline. He was hitting all the major life milestones, one after another. A great career spanning 25 years, marriage, kids. He even bought his first home pretty young, which, made his parents incredibly proud. He was following the script that society writes for us. But fast forward to age 50, and all that success was just a mask for a deep, deep sense of unease. And this is the part that's so fascinating, right? This incredible contradiction. He'd worked his tail off his entire life. His career was on a great track, but he felt like he had almost nothing to show for it. He literally felt as financially vulnerable at 50 as he did back in his 20s, just starting out. How is that even possible? Well, the answer, as you might guess, is in the financial decisions he made along the way. So let's get into the nitty-gritty of his financial journey. We're going to see how the choices he made over almost 3 decades, choices that seemed totally sensible and safe at the time, were actually leading him down a really dangerous path. So, his journey began like so many of ours do. His daughter was born, and suddenly saving felt urgent. So what did he do? He turned to fixed deposits. He bought gold, but as jewelry, just like his parents told him to. He bought a house, taking on a massive loan with, get this, interest rates around 13 to 14%. And the stock market? Oh no. To him, that was the scary, dark casino where all his friends just seemed to lose money. These all sound like things a responsible person would do, don't they?
Well, eventually, he did dip his toes into the stock market, but he did it in pretty much the worst way imaginable. See, he wasn't investing, he was just gambling. He'd hear a hot tip from a guy in the next cubicle, buy the stock, and then watch it obsessively. The constant buying and selling, plus the insane brokerage fees, we're talking over 1% for every trade, meant his portfolio was just churning water. The only person getting rich was his broker.
And this is such a classic fear-based mistake. The 2008 crash absolutely terrified him. It wiped out what little he had in stocks and cemented this idea in his head that stocks were just imaginary paper and real estate was the only real thing. So what did he do? He went all in. He started lending his own money to builders and booked a second apartment. But then the real estate market cooled down, the builders went bust, and that second flat, it was never even finished. All that money just gone.
Okay, so this is where everything changes. Mr. Talwar is completely overwhelmed. He's looking at retirement and thinking, there's no way I can afford this. So he finally does what he should have done years earlier. He seeks professional help. He meets this advisor, Nikhil, who tells him, look, we need to stop talking about feelings and perceptions. We need to look at the cold, hard numbers.
And so Nikhil asks this incredibly simple but absolutely brutal question. After 27 years of hard work, of diligently saving, of investing across all these different things, what was the real, bottom line, average annual return on his entire net worth? What did the math actually say? And here it is, the truth laid bare. His fixed deposits in gold, they barely kept pace with inflation. His first home did okay, which is good, but look at the big bets he made. The second house was a total loss maker. His stock trading over all those years, it returned a grand total of 0%. And the money he loaned to the builders, a complete 100% wipeout, gone. So when Nikhil crunched all the numbers and calculated the weighted average return across his entire portfolio, the final number was just devastating. After 27 long years of effort, Mr. Talwar's entire net worth had grown by a pathetic 4% per year. That's a number so low, it was barely even beating inflation. All that work, all that stress, for basically nothing. That 4% figure was the slap in the face he needed. It was a wake-up call that forced him to finally confront his mistakes. And that's when Nikhil showed him the powerful alternative he had been scared of for decades, investing in equities, but doing it the right way. You see, the problem was never stocks as an idea. The problem was his approach. He was acting like a trader in a casino, not an investor building wealth. He was trying to jump in and out based on rumors, churning his account and paying a fortune in fees. Nikhil showed him that the real path, the proven path, is patient, disciplined, long-term investing. You stay in the market, you don't try to time it. And if you want to see the real cost of his fear, just look at this. Nikhil showed him this chart. If he'd put 1 lakh rupees into a fixed deposit back in 1990, it would have grown to 10 lakhs. Gold, 12 lakhs. Not bad. But what if he had just put that same 1 lakh into a simple index fund tracking India's top companies, like the BSE Sensex, and just left it alone? It would have been worth 64 lakhs. The difference there isn't just numbers on a page, it's a completely different life. Now here's the thing, Mr. Talwar's story isn't some rare, unusual case. It's a story about all of us, because the mistakes he made are incredibly common. So let's break down the 7 specific traps he fell into so we can make sure we don't do the same. Here they are, the 7 deadly sins of investing. 1, he had no plan, he just chased tips. 2, he traded constantly, making his broker rich. 3, he wasn't diversified, he bet the farm on real estate. 4, he let high fees just bleed his account dry. 5, he got greedy, chasing those risky returns from the builders. 6, he thought he could outsmart the market. And finally, number 7, he totally forgot about the silent killers of wealth, inflation and taxes. You put all those together and it's a perfect recipe for disaster. So what's the takeaway for you? Especially if you're like Mr. Talwar and you're at that stage in your career where you can see the finish line. How do you make sure these last few years are your most powerful and productive ones?
I absolutely love this analogy. Mr. Tawar finally realized he was in the slog overs of his career. You know, in cricket, that's the end of the match. The pressure is on and you need to start hitting big shots to win the game. The question that just ate away at him was, after a lifetime of playing it safe and still losing, who is going to step up to the crease and start hitting sixes for him now? So, let's boil it all down. Here are the big lessons from his story. First, for God's sake, have a plan. Know your goals. Second, question that old school wisdom. Just because your parents invested in real estate and gold doesn't mean it's the best way to build real wealth today. Third, you have to embrace the fact that patient, long-term investing in great businesses is the most powerful wealth creation engine ever invented. And finally, you have to be absolutely obsessed with keeping your costs low, because every single rupee you pay in fees is a rupee that's not working for you. And that really brings us to the final thought I want to leave you with. Mr. Talwar found his answer. He found it in a disciplined strategy with professional guidance. So as you think about your own financial future, whether you have 5 years left in your career or 30, the question is exactly the same. What's your plan? What strategy, what mindset is going to be the MS Dhoni for your portfolio? Who or what is going to step up and hit those winning runs for you?
All right, let me ask you something. What if the secret to building some serious long-term wealth wasn't about frantic trading or staring at charts all day, but about doing, well, almost nothing? Today we're going to dive into a radically simple philosophy called coffee can investing. It's designed to help you sidestep the single biggest trap in the market. And you know what? It might just change how you think about your money forever. Let's get into it.
To really wrap our heads around why this strategy is so powerful, we have to start right here with this incredible insight from the father of value investing himself, Benjamin Graham. He knew that the biggest obstacle to your success isn't some crazy market or a lack of secret information. Nope, the real problem is usually staring right back at you in the mirror. It's us. It's our own emotions, our panic, our greed, that almost always lead us astray.
And hey, if you think you're immune to this stuff, let me tell you a little cautionary tale. We're talking about a guy who literally invented calculus and figured out the laws of universal gravitation. I am, of course, talking about Sir Isaac Newton. But as we're about to see, being a certified genius in physics is absolutely no defense against the madness of the market.
Now, the story behind this quote is just fascinating. Back in 1720, Newton made an absolute killing on the hottest stock in England, the South Sea Company. He doubled his money, pocketed a huge gain, and as he walked away, he supposedly said this. He saw the bubble forming, and he got out. A stroke of genius, right? Well, not so fast.
This is the amount Newton lost just a few months later. And in today's money, that's over $3 million. So what happened? Well, he couldn't stand watching his friends get even richer. He got swept up in the mania, the FOMO got to him, he jumped back into the market at a much, much higher price. And he was financially wiped out when the whole thing came crashing down. He learned the hard way that emotion is the ultimate enemy of profit.
So, how do we avoid making the same mistake as Newton? That's exactly what we're going to break down. First, we'll unpack this idea of being our own worst enemy. Then, we'll pull some wisdom from the legends, uncover the buy and forget portfolio, and I'll give you a simple recipe for greatness. We'll also see the incredible power of just doing nothing, and finally, I'll leave you with 3 key takeaways.
Okay, let's start with the core problem here. So many of us get this confused. We think that constant action, checking prices, reading headlines, buying, selling, is the same thing as making progress. But more often than not, all that activity is just a destructive cycle of emotional decision-making. This slide lays it out perfectly. It shows the 2 paths you can take. Over on the left, you've got the punter. This is basically Sir Isaac Newton in his second trade. He's reacting to market noise, chasing short-term tips, and letting his emotions run the show. And this approach, it really only benefits one group, the intermediaries, the brokers who get a little piece of every trade you make. But on the right, you have the true investor. Their focus is totally different. They're thinking about the underlying business, their horizon is decades, not days, and they are patiently building personal wealth by owning a piece of a truly great company.
So, if we want to move from being a punter to being a real investor, who better to learn from than the absolute legends of the game, right? Let's take a look at the foundational principles that the world's most successful investors have been using for decades.
Warren Buffett's approach is famously straightforward, but that doesn't mean it's easy. He looks for 5 key things. First, a business he can actually understand. No complex tech he can't get his head around. Second, a business with good long-term prospects. Third, and this one is absolutely crucial, an enduring moat. Some kind of durable competitive advantage that protects it from competitors, just like a moat around a castle. Fourth, management you can actually trust. And finally, buying it all at a sensible price. See, not one of these things has anything to do with predicting what the market's going to do next week.
But you know, buying the right company is only half the battle. The second piece of wisdom is what you do after you buy it. Buffett says his favorite holding period is forever. Think about that. So many of us do the exact opposite. We sell our winners to lock in a small profit, but we hang on to our losers forever, hoping they'll turn around. The great investor Peter Lynch called that cutting the flowers and watering the weeds. True wealth is built by letting your flowers grow into a giant, beautiful garden.
And this whole philosophy of buying great businesses and just holding them forever, it actually led to this powerful discovery almost completely by accident. It's the origin story of what we now call the coffee can portfolio.
You have to hear this story. Back in the 70s, an investment manager named Robert Kirby was advising a client. Every time he recommended a stock, her husband would go and buy $5,000 worth for his own personal account. But here's the kicker. The husband never, ever sold anything. For 10 straight years, he completely ignored every single sell recommendation Kirby made. A decade goes by, and Kirby discovers this forgotten portfolio had absolutely crushed his own professionally managed one. And why? Because one of those small $5,000 bets in a little company called Xerox had grown to be worth over $800,000. The husband's inactivity, his decision to do nothing, had allowed a true winner to run wild.
And that is exactly how this strategy got its name. It's a throwback to the old days in the American West, before banks were on every corner. People would put their valuables, cash, gold, whatever, in an old coffee can and hide it under the mattress for safekeeping. The idea is exactly the same. Find valuable assets, put them away somewhere safe, and then just forget about them. You let them grow undisturbed for a very, very long time. Okay, this all sounds great in theory, right? But how do we actually find these great companies to put into our coffee can? Well, researchers have come up with a beautifully simple but very strict recipe based on two non-negotiable rules. Here they are, two simple yet incredibly tough filters. First, consistent growth. The company has to have grown its sales by at least 10% every single year for the past decade. No down years allowed. Second, consistent quality. It has to have generated a return on capital employed, or ROCE, of at least 15%. Again, every single year for 10 years. Now this ROCE is basically a measure of profitability, and we'll dive into that next. This level of consistency is really what separates the good companies from the truly great ones.
So let's break down this ROCE thing. In simple terms, it just measures how good a company is at turning a dollar into more dollars. For every single dollar of capital it uses, and that's both shareholders' money and debt, how much profit does it spit out? A consistently high ROCE, one that's above 15%, is basically the financial signature of a business with a powerful moat. It's proof that the company is highly efficient and earning returns well above what it costs to fund its own operations.
Now let's look at a real-world example to see how this plays out. Page Industries, the company that runs the jockey franchise in India, is a textbook case study. Just look at these numbers. For 15 years, it consistently passed both of our tough filters. But the results are even more staggering. Revenue grew at 31% a year. Earnings grew at 40% a year. And its average ROCE was an unbelievable 55%. This is what a truly great business looks like on paper.
And now we come to the hardest part of all. You've used the recipe, you've found the great companies, and you've built your portfolio. Now you have to execute the most difficult step of the entire process. Absolutely nothing. Let's look at why resisting that constant urge to tinker and to trade is actually your most powerful advantage.
This chart just completely reframes the whole idea of risk. If you invest for just one day, your odds of making money are basically a coin flip, about 51%. But hold on for a year and your odds jump up to 70%. Now look at that 10-year mark. Your probability of a positive return approaches 100%. This just proves that time is your greatest ally. It transforms the market from a casino into a genuine wealth creation machine.
And this table shows you why time is so powerful. Just imagine a simple portfolio with only two stocks. One is a huge winner, compounding at 26% a year. The other is a total dog, declining by 26% a year. After 1 year, you're pretty much flat. But just watch what happens over time. After 5 years, your portfolio is worth $207. After 10 years, it's worth $634. The loser, stock B, has faded into total irrelevance. It's basically gone. Meanwhile, the winner, stock A, completely dominates your returns, and your overall portfolio still compounded at a fantastic 17.6% a year. This is the magic of letting your winners run.
So, what does this actually deliver in the real world? Well, in extensive backtesting of this exact strategy, the median compounded annual return of a coffee can portfolio was 24%. Let me put that in perspective for you. A 24% annual return grows your money 10 times over in a decade. That is the incredible power you get when you combine great companies with a long-term, do-nothing approach.
Okay, we have covered a lot of ground, from Sir Isaac Newton's big mistake to the simple genius of Robert Kirby's client. So let's bring it all together and distill this down into 3 clear, actionable principles you can take away with you today.
Here it is, the entire philosophy on one slide. First, and most importantly, ignore the noise. Most of the chatter and so-called advice out there is designed to make you trade, which only benefits the brokers, not you. Real success comes from owning great businesses. Second, use the simple recipe we talked about. Look for that decade of incredible consistency. Over 10% sales growth and over 15% ROCE year after year. And third, just let compounding do its work. The most profitable action you can take is often no action at all. Build a portfolio, put it in the can, and let your winners do all the heavy lifting for the next decade.
And that really brings us to the final, most important point. The strategy itself is simple. The rules are crystal clear. You have the recipe. But the real challenge here isn't finding the right stocks. It's psychological. It's having the discipline to fight your own worst instincts, to leave that portfolio alone and just let it cook. So the question is, can you do it? Thanks for joining me.
You know, what if I told you that the biggest threat to your long-term wealth isn't some crazy stock market crash, but a slow, silent leak in your portfolio that you're probably not even aware of? We all spend so much time and energy chasing the best returns, right? Looking for that next big thing. But today, we're going to pull back the curtain on a hidden financial secret that, frankly, the industry hopes you'll ignore. The tiny expenses that are secretly costing you a fortune. Let's get into it. Benjamin Franklin said this centuries ago, and he probably wasn't thinking about mutual funds, but wow, has this quote ever been more relevant for an investor today? Just think about it. Your portfolio is that great ship. You've built it carefully to carry you towards your financial freedom. And those small leaks? Well, those are the fees, the commissions, the hidden charges. They seem so insignificant by themselves, but believe me, over a lifetime of investing, they can absolutely sink your returns. Let me tell you a story about a guy named Mr. Talwar. He was, by all accounts, a really smart investor, but he was obsessed with one thing, and one thing only: gross returns. You know, the big, flashy numbers. He loved seeing them, but he never, ever bothered to look under the hood at the costs. And because of that, between high brokerage fees and some really complex insurance products he'd been sold, he was losing up to 7% of his portfolio every single year. His ship wasn't just leaking, it was taking on water fast. So how do we make sure we don't end up like Mr. Talwar? Well, here's our game plan. First, we'll expose the real cost of those so-called good returns. Then we're going to look at the destructive power of compounding fees, and it is shocking. After that, we'll explore why the old ways of investing just don't work anymore, arm you with a new set of tools, and finally, boil it all down to 3 simple rules to protect your money. All right, first up, let's dismantle the big illusion that trapped Mr. Talwar and honestly so many other investors. This is all about knowing which numbers really matter and, more importantly, which ones are just noise. Okay, this is the heart of the matter. Gross returns, that's the headline number, right? It's the big, shiny figure you see in all the ads. It's the performance before anyone takes their cut. But net returns, that's the money that actually lands in your pocket. That's what you get to keep. At the end of the day, it's the only number that has any real impact on your wealth, but it's the one that we're constantly trained to overlook. I love this analogy. Paying high fees right from the get-go, it's like sending your team out to bat in a cricket match, but you're already 4 wickets down before a single ball has even been bowled. You are starting so far behind that it becomes almost impossible to ever catch up, let alone win. You're fighting an uphill battle from day one. Now, let's talk about how this problem gets exponentially worse over time. You know, we all love the magic of compounding when it's growing our money for us. But there's a dark side to that magic. Fees compound too. And they work silently, relentlessly, against you year after year after year. So what are these silent wealth killers? Well, they come in a few different forms. First, you've got the obvious ones, transaction fees or brokerage that you pay every time you buy or sell. Then there are the persistent ones, like the annual management fees. And finally, you've got the sneakiest of them all, hidden fees, buried so deep in the fine print of complex products, you'd practically need a magnifying glass to find them.
Okay, to see the real damage here, let's run a quick experiment. Imagine we invest 1 lakh rupees into 2 different funds. On the surface, they look identical. Both are giving you a solid 15% gross return every year. The only difference is the annual fee. Fund A charges 2.5%, pretty typical. Fund B is a super low-cost fund charging just 0.1%. Now, that sounds like a tiny, almost meaningless difference, right? Well, let's see.
Okay, after just 10 years, that tiny difference is, well, it's not so tiny anymore. The portfolio in the low-fee fund, Fund B, is already a full 24% larger than the one in the high-fee fund. A quarter of your potential growth, poof, gone, eaten up by fees. Now let's jump forward another 10 years. So after 20 years, what was a gap has now become a massive canyon. The low-fee funds portfolio is now 53% larger. That small leak we talked about at the beginning, it's now a full-blown torrent, just washing away your hard-earned returns in Fund A.
And this is the final result after a typical 40-year investing journey. And honestly, it's staggering. That initial 1 lakh in the high-fee fund, it grew to 1.11 crore. Not bad, you might think. But look at the low-fee fund. It grew to 2.58 crore. That is a difference of over 1.4 crore rupees. More than half of your potential wealth just vanished. All because of a seemingly small 2.4% annual fee. This right here, this is the single most important, controllable factor in your long-term success.
Okay, I can hear what you're thinking. I get it, fees are bad, but surely a brilliant fund manager, a real star, is worth paying for, right? And that's a fair question. But the answer to that question is changing, and it's changing fast. We're in an era where finding that consistent outperformance, or alpha, is becoming almost impossible. So for a little bit of context, the mutual fund industry in India really took off in the 90s when private companies jumped in. The growth was just exponential. And back in those early days, with less competition, it was actually easier for a really skilled manager to find hidden gems and beat the market. But that world is long gone. So this brings us to a really important distinction: active funds versus passive funds. Active funds are the ones with the star managers, right? They've got teams of analysts, and they're actively trying to pick winning stocks to generate alpha. That's just a fancy word for beating the market. And they're expensive because you're paying for all that supposed genius. Passive funds, on the other hand, they don't try to be clever. They just track an index like the Nifty 50, aiming to match the market's performance. And because they're mostly run by computers, their fees are incredibly low. You know, the biggest problem with paying for a star manager is that genius is really hard to find. And it's even harder to stick with. Just look at this data. Of the top performing funds over a few years, only about a third of them managed to stay on top. But get this, a staggering 45%, that's nearly half, plummeted all the way to the bottom half. So picking a winner based on past performance, it's pretty much a coin toss. The alpha they promise has almost vanished because the markets are just too efficient now. Now, I know this all might sound a little discouraging, but this is where the story takes a really fantastic turn for us. The game has changed. For the first time, the power is shifting away from the big institutions, and it's coming back to you, the individual investor. We have a whole new toolkit to fight back. The regulators, especially SEBI, have really been on our side here. They stepped in and got rid of those awful upfront fees called entry loads. They capped commissions, they forced transparency so you can see who's getting paid. And then, this was the absolute game changer. In 2013, they mandated that every single mutual fund must offer a direct plan. This move effectively cut out the expensive middlemen. And are investors like you and me taking advantage of this? Oh, you bet we are. This chart shows a massive shift. By 2017, nearly 40% of all the money in mutual funds had already flooded into these new low-cost direct plans. People are voting with their wallets, ditching the old expensive model for something way smarter. And this table just puts a hard number on that simple choice.
Okay, so a direct plan might save you about 1% in fees compared to a regular plan. Sounds like nothing, right? While over 40 years, that tiny 1% difference on our 1 lakh investment adds up to an extra 50 lakh rupees in your pocket. That's not just a small change, that's a life-changing amount of money. This whole shift has also given rise to a much, much better way to get financial advice. It's called the advisory-only model. It's simple. You pay a professional a flat fee directly for their expertise. Because their income comes from you and you alone, their only incentive is to help you succeed. This completely gets rid of the conflict of interest in the old system, where so-called advisors were really just salespeople pushing expensive products to earn a commission.
Okay, we have covered a ton of ground, so let's bring it all home and distill everything down into 3 simple, powerful rules for your money. Think of this as your new playbook for building wealth in today's world. Okay, rule number 1, always, and I mean always, focus on your net returns. Forget the marketing hype. What you actually keep is the only thing that matters. Rule number 2, for the main part of your portfolio, you should favor low-cost, passive funds. The data is just overwhelming. Paying high fees to chase a star manager is, most of the time, a losing game. And rule number 3, separate advice from sales. Pay an advisor who actually works for you, and then go and invest through low-cost direct plans. You follow these 3 rules, and you will be miles ahead of almost everyone else. So, I'll leave you with this one final question. After everything we've looked at today, it's really not a question of if your portfolio is leaking money through fees. It's just a question of how much. So the only real question left is, what are you going to do about it? It's time to lift the hood, check the numbers, find those leaks, and plug them for good. Your future self will thank you for it. All right, let's get right into it. We're going to talk about something that's, well, it's more than just an investment in India. It's practically a religion. I'm talking about real estate. For decades, it's been seen as the safest, smartest, can't-lose way to build wealth. But what if that's not true anymore? What if it's actually a trap? You know the phrase, of course. Roti, kapada, aur makan. It's been drilled into us for generations. And that last part, the makan, the house, it was always more than just a roof over your head, wasn't it? It was security. It was status. It was the ultimate sign that you had made it. It was something real, something tangible you could pass down. And then, that deep-seated belief got thrown into overdrive. Between 2003 and 2013, we had what you could call the golden decade. Prices didn't just go up, they went ballistic. Seriously, properties in places like Gurugram shot up over 600%. Flats in Mumbai's Lower Parel jumped almost 8-fold. Regular people became crore-potis, and the legend was sealed. Real estate was a one-way ticket to riches. But here's the crucial question we have to ask ourselves today. What if that incredible, once-in-a-lifetime boom wasn't the rule, but the exception? What if the memory of that golden era is blinding us to the reality on the ground right now, setting up a huge, dangerous trap for today's investor? That's what we're going to deconstruct. So to really understand this trap, we have to strip away the emotion and look at residential real estate for what it is, an asset. And when you do that, you find that it has 5, let's call them hidden flaws, that make it a uniquely difficult and frankly risky investment. First off, the price of entry is huge. You need lakhs, if not crores. It's not like buying a few shares of a stock. Second, it is painfully illiquid. You can't just sell it tomorrow if you need the cash. Selling a property can take months, sometimes even years. Third, the costs just to buy and sell are punishing. We'll get to that. Fourth, every property is different. Your apartment's value could stagnate while one on the next street over does okay. It's a lottery. And finally, let's be honest. It's a murky business, full of hidden hurdles where the average person is often at a huge disadvantage. Okay, I really want to zoom in on those transaction costs. Think about this. Between stamp duty, registration fees, brokerage, you're looking at over 10% of the property's value gone, just like that, vanished. Before you've earned a single rupee, you're already starting in a 10% hole. No other mainstream investment comes even close to being that expensive to trade. So if the basic structure has so many problems, why do we keep falling for it? Why is the pull so strong? Well, this is where it gets interesting, because it's less about spreadsheets and more about psychology. It's about the stories we've been told and the stories we tell ourselves. The biggest story of all is the myth that house prices only go up. An entire generation of investors came of age during that 2003 to 2013 boom, so they've literally never seen a serious downturn. It created this powerful, dangerous belief that it's a sure thing. And it doesn't help that in India, unlike in other countries, we don't really have a single reliable price index that tells us what's actually happening in the market. But history tells a very, very different story. You just have to look back a little further. Check out what happened in the late 90s. South Mumbai, down 30%. South Delhi, down 35%. Bangalore, down 30%. This wasn't some minor blip. This was a significant crash. The market absolutely can and does go down. Here's another mental trap we all fall into. Someone says, my property went up 5 times in 20 years, and it sounds incredible, right? But when you actually crunch the numbers, that's a compounded return of only 8.3% a year. You know what the stock market index did over that same time? Something closer to 15% per year. We get seduced by the big, shiny, absolute number and completely miss the fact that our money could have worked much, much harder somewhere else. Okay, so you might be thinking, is this just an India thing? It's a fair question. So let's zoom out. Let's take a global reality check and see how real estate has performed in other, more mature markets over the very long term. The answer might surprise you. Just look at this. This is data from the US going back over 100 years. $1 put into the stock market grew to over $30,000. That same dollar put into real estate, it became just $161. I mean, it's not even a contest. It's a completely different universe of returns. And no, this isn't some American anomaly. You see the same basic story play out in most developed countries around the world. Over the long haul, once you account for inflation and all the costs, real estate as an asset class delivers surprisingly minimal returns. The idea that it's this amazing wealth creator is, for the most part, a global myth. All right, so let's bring it all back home. Back to India, right here, right now. Because after that golden decade ended, the market dynamics shifted completely. And the data today, well, the data doesn't lie. It points to a market with some very deep structural issues. First and foremost, affordability, or rather, the lack of it. This chart compares property prices to the average person's income. And look at that. India is at 63.5. We're not just a little more expensive than China or the US. We are in a different galaxy. Our property is the most expensive in the world relative to our income by a massive margin. These prices are just not sustainable for the average home buyer. So if prices are stagnant, what about rental income? Well, that's what we call rental yield. And in India, it's a pathetic 2.4%. That is among the lowest in the entire world. Think about it for a second. Why would anyone take on all the risks, the costs, and the headaches of being a landlord for a 2.4% return when you can just buy a super safe government bond and get 6 or 7%? Financially, it makes absolutely no sense. And you have this number, which is just mind-boggling. Across India's top 8 cities, there are so many unsold, empty homes that at the current pace of sales, it would take 11.5 years to sell them all. That's not a small problem. That is a sign of a colossal oversupply that is going to weigh down prices for a very, very long time. Okay, so we've seen the fundamental flaws, the psychological traps we fall into, and the cold, hard data from both here and abroad. So where does that leave us? What's the final verdict? It's time to seriously reevaluate how we think about real estate in our investment portfolios. After looking at all this evidence, you have to ask yourself a very simple, direct question. Does residential property, as a pure investment, I'm not talking about the home you live in, but as a tool to grow your wealth, does it really deserve your hard-earned money? Let's just boil it down to 3 key takeaways. Number 1, its long-term returns have been pretty poor compared to equities. Number 2, it is ridiculously expensive and difficult to trade, with costs and taxes eating away at your money. And number 3, the boom from 2003 to 2013 created a price bubble. The market now has to go through a long, painful period of stagnation, a time correction, to get back to reality. Look, at the end of the day, it really comes down to this. The home you live in is incredibly important. It gives you shelter, stability, priceless memories. There's no denying its emotional value. But we get into trouble when we confuse that emotional value with financial performance. So the final question I want to leave you with is this. Your home is essential for living your life, but is it the best tool for building your wealth? The evidence strongly suggests we should probably look somewhere else. You know, when you think about investing, it's usually the big guys, the giants, that grab all the headlines. But something really interesting has been happening in India lately. The smallest companies have been making the biggest noise, attracting an absolute tidal wave of money. So today, we're going to dive deep and unpack the frenzy behind India's small-cap gold rush. Right, so what is going on here? I mean, really, why this sudden, massive flood of investment into what's essentially the bottom of the market? To get to the bottom of it, you've got to follow the money. Where did all this cash suddenly come from? I mean, just look at this. The sheer scale of this shift is, well, it's staggering. This chart shows the money flowing into mutual funds that focus on small and medium-sized companies. You see that jump between fiscal years 2014 and 2017? It's practically a vertical line. But here's the thing. To really get why this happened, we've got to jump in a time machine and go back a few decades. Because believe it or not, this isn't the first time everyday Indian investors have absolutely piled into the market. All right, let's rewind. This whole story really kicks off with the first big romance between Main Street India and the stock market. And like a lot of first loves, it ended with some serious heartbreak. Man, the early 90s, what a wild time. The Indian economy was opening up, and the Sensex quadrupled in less than 2 years. The public went nuts for stocks. Think about this. We're talking about 4,000 companies going public in just 4 years. That's an average of 4 IPOs every single day. It was pure chaos, total euphoria, a classic gold rush. And, this quote from Sankara Narayan, a top investment guy, just hits the nail on the head. He's basically saying, look, we all got swept up in it. Even the pros. They thought they were geniuses, that this one-time boom was the new reality. They got drunk on the easy money, made a ton of mistakes, and, well, they paid for it. And just like any wild party, this one ended with a brutal hangover. Regulators stepped in to clean things up. A huge change was this move from paper stock certificates, the actual physical things, to electronic records. Now, this was a great move for making things transparent, but it had this massive unintended consequence. All that black money, that unaccounted for cash that was really fueling the fire, it couldn't hide in the stock market anymore. And so for the next 20 years, that money, and a lot of regular investors who got burned, they stayed away. Okay, so if all that cash vanished from the stock market, where did it go? Well, that brings us to the next chapter in this saga, what I'm calling the Great Money Migration, and you'll see how it all comes full circle. For about 20 years, the answer was pretty simple. It went into physical stuff. Unaccounted cash just poured into real estate and gold. Why? Because you could easily use cash for those transactions. No questions asked. But then, after 2014, the game completely changed. A whole series of government policies came in that made it way, way harder to park that kind of money in property or gold. And all that cash suddenly needed to find a new place to live. And look, this wasn't just one thing. It was a full-on systematic campaign. Step 1, direct benefit transfers. This cut off a huge source of cash that was being siphoned from government subsidies. Then, of course, the big one, demonetization in 2016. That forced a tidal wave of physical cash back into the official banking system. And to top it off, you had new real estate laws and the national GST tax. Suddenly, transparency and paying your taxes became the law of the land. It was like all the old hiding spots for cash were being boarded up one by one. So what was the result of all this? What happened when you squeezed all that money out of the physical world? You get this. This one, absolutely staggering number, a 73% annualized growth rate in the money from everyday folks pouring into mutual funds, just between 2014 and 2017. The money that had run away from stocks 20 years before was now rushing back in. So we've solved the first mystery. We know where the money came from. But why was it all flooding into small companies? And that right there is the heart of this whole frenzy. With all this capital flooding back into the market, why did small caps become the hot new thing? Why all of a sudden is small so beautiful? Well, it really comes down to two big, powerful ideas. First, it's just simple math. A small company has so much more room to grow its profits. To double or triple or grow tenfold, compared to a massive company that's already a giant. And the second idea is what you might call the discovery effect. The fact that these small companies are often flying completely under the radar. This chart just shows it perfectly. You see, the big, large-cap stocks, they have armies of analysts from all the major brokerages watching their every move. Every single press release is dissected. But look what happens as you go down the size ladder. The coverage just falls off a cliff.
When you get to the small caps, they're basically ignored. And that means there's a real chance you can find an undervalued gem before anyone else does.
Okay, so take that lack of coverage, and now look at this. The small cap world isn't just a category, it's a universe. It is absolutely vast. There are thousands upon thousands of these companies, way more than all the large and mid caps put together. It's just physically impossible for those few analysts to keep track of them all.
So what you're left with is this simple but really powerful equation for investors. You have a massive number of companies, plus very few people actually researching them. And that equals the potential to find hidden gems. It's the perfect setup for a treasure hunt.
But, and this is a huge but, it's never that simple, is it? Because for every diamond in the rough, there are a whole lot of worthless rocks. We have to talk about the other side of the coin here. The very real, very serious risks that come with playing in the small cap sandbox.
Let's be honest, smaller companies are just plain riskier. They might have a great idea, but they don't have the IT systems or the HR department to actually manage fast growth. A lot of times, the founder who started it all doesn't want to let go and bring in professional managers. Or maybe they depend entirely on one single product. What happens if demand for that product just disappears overnight? And then there's the ugly stuff. Frankly, there's just more room for a bit of, let's call it accounting skullduggery.
You want a real-world example? This quote from Captain Gopinath, the founder of Air Deccan, is just heartbreaking. This guy literally pioneered low-cost air travel in India, a total game changer. But the company failed. And in his own words, it's because his IT system just collapsed under the pressure of all that growth. It makes that risk, that failure to scale, feel incredibly real.
And look, this isn't just about sad stories. The hard data backs it up completely. This chart here is based on a model that's designed to sniff out accounting problems. And the trend is crystal clear. The smaller the company, the higher the probability that something shady is going on with the books. The risk of stepping on a landmine is just higher.
Okay, so what are you supposed to do with all this? Where does this leave you, the investor? On one hand, you have this incredible opportunity. On the other, you have these massive hidden dangers. It's the classic dilemma. So the big takeaway here, the conclusion you just can't avoid, is this. Sure, the potential to hit a home run, to get those life-changing returns, it's definitely higher with small caps. But the risk of striking out is magnified right along with it, which means the need for really deep, professional, roll-up-your-sleeves analysis isn't just some nice-to-have. It is absolutely critical. This is not the part of the market where you just throw a dart at a board.
And that really brings us to the final crucial question. You see, the small cap world is full of potential rocket ships, companies that could just soar into the stratosphere. But it's also littered with falling stars, companies that are just going to flame out and disappear. So the question you have to ask yourself is, how are you going to tell the difference?
All right, let's talk about two of the most important and maybe most misused words in all of investing: patience and quality. Today, we're going to dig into how getting these two things right can totally transform the way you think about building wealth, not just for next year, but for the long haul.
You know, I really love this quote because if we're being honest with ourselves, investing can feel exactly like trying to control the weather. It reframes patience so perfectly, doesn't it? It's not just sitting on your hands and waiting. It's an active, deliberate skill. It's the art of understanding deep down that you can't command the markets, so you learn to work with them instead.
And that really brings us to this big puzzle, what I like to call the investor's paradox. We hear it all the time, right? The market always goes up over the long term. So why does it feel like so many people get burnt? Why do so many feel like they're losing? There's this huge gap between the cold hard data and what we actually feel in our gut when our money's at stake. Okay, let's put a real number on this. Over the last 26 years, the BSE Sensex has returned a compounded annual return of 13.7%. Just let that sink in for a second. That is a serious, wealth-creating, inflation-destroying number. The data is absolutely crystal clear. The market has delivered. So, if the market isn't the problem, well, the problem must be somewhere else.
So here's how we're going to crack this thing open. First, we're going to really diagnose that paradox. Then, we'll look at the first part of the solution, this idea of a patience premium. After that, we'll add the second secret sauce, the quality premium. We'll see what happens when they work together, and then I'll leave you with 3 key takeaways you can actually use.
All right, let's jump in. Part 1, the investor's paradox. Like we said,
The answer isn't buried in some financial report. It's actually wired right into our own brains, into the psychology of how we think about winning and losing. And the technical name for this wiring problem is myopic loss aversion. Now, don't let the fancy words fool you. It's actually pretty simple. Loss aversion just means the pain of losing 100 rupees feels about twice as bad as the joy of gaining 100 rupees. And myopic? Well, that just means we're naturally short-sighted. We focus on the pain or joy of right now. This slide just makes it so obvious. I mean, look at this. You lose 5 rupees, but you gain 10. Logically, you're up 5 rupees. You should be happy, right? But emotionally, that 5 rupee loss feels like a 10 rupee punch to the gut. The pain from that tiny loss can completely cancel out or even overpower the good feeling from a gain that's twice as big. And that is exactly why you can have a portfolio that's doing well but still feel like you're losing. So, if being short-sighted is the problem, what's the cure? It's the first half of our solution, the incredible, almost magical power of patience. You see, time is the only weapon we have that can systematically fight back against this emotional glitch in our brains. And this table tells the whole story. Just look at these numbers. If you're investing for just 1 month, your chance of making money is a little better than a coin flip, 57%. But watch what happens as you just wait. Stretch that out to 5 years, and suddenly you're at an 89% chance of being up. And at 10 years, 98%. It becomes almost a statistical certainty. Time literally just irons out all that scary day-to-day noise. And this right here, this is the psychological turning point. At 1 year, your chance of a gain is 68%, and your chance of a loss is 32%. See that? 68 is more than double 32. This is the absolute minimum holding period you need for the math to finally get strong enough to overpower that 2-to-1 emotional pain of loss we're all wired with. But you know what? It gets even better than that. Because patience doesn't just increase your odds of making a profit. It does something way more powerful. It actually lowers your risk. This is what I call the patience premium. Just look at this chart. That massive bar on the left, that's the volatility, the risk, the stomach-churning ups and downs you feel in a single year. But look what happens when you hold for 5 years. The risk just collapses. By 10 years, it's 6 times lower. Patience doesn't just earn you more money, it buys you peace of mind. Okay, so we've got a solid foundation. Patience is the bedrock. It cuts risk, it improves your odds. But now let's ask a really interesting question. What if we get a little picky about what we're being patient with? Let's add that second ingredient to the mix, quality. And we call this bonus the quality premium. It's basically the extra performance you can capture when you decide to be patient with a hand-picked portfolio of fantastic companies instead of just owning the whole market. It's the reward you get for choosing better building materials from the start. Now, to really get a feel for how quality works when the pressure's on, we need to take a little detour to the cricket pitch. I want you to think of Rahul Dravid, the wall. His whole game was about solid fundamentals, defense, protecting his wicket. He wasn't always flashy, but he was the very definition of quality and reliability.
And this is the part that just blows my mind. You would think the big, aggressive hitter, Sehwag, would be the star in the crazy, volatile world of T20 cricket. But look at the numbers. Dravid, the master of defense, doesn't just do better. His biggest outperformance, a massive 57% advantage, comes in the shortest, most chaotic, most volatile format of the game.
And that's the whole point. High-quality stocks are the Rahul Dravids of your investment portfolio. It is because they are so solid and dependable that they give you their biggest advantage when the market is at its most volatile. Their quality shines the brightest right when the storm hits. So, there we have it. We've got patience, which lowers our risk over time, and we've got quality, which protects us when times get tough. Now let's put these two superpowers together and see if we can find the Holy Grail. First, let's just picture the entire universe of investing on a simple map. You've got risk on one axis, return on the other. The top left corner, that's the bad neighborhood. High risk, low return. We want to stay away from there. The goal, the paradise, is the bottom right. High returns for low risk. So we already know what patience does. As you see here, investing in the broad market for just 1 year starts you off in that riskier territory. But as you stay patient over 10 years, you take this amazing journey right across the map, landing squarely in that beautiful bottom right quadrant. But, and this is the final crucial piece of the puzzle, when you add quality to the mix, you get to cheat. You don't even start in the same place.
A quality portfolio, like the coffee can portfolio, begins its journey from a much better starting point, already lower risk and higher return. And when you give it 10 years of patience, your journey ends even deeper in that ideal zone, leaving the regular index far, far behind.
So, after all that, from human psychology all the way to the cricket pitch, what does this actually mean for you? Let's boil it all down to 3 simple, powerful ideas that you can build a whole philosophy on.
Okay, here they are. Number 1, the patience premium. Remember that time is your friend. It turns a risky bet into a smart investment. Number 2, the quality premium. High-quality companies are your shield during market storms. And number 3, the holy grail. When you combine patience and quality, you unlock the potential for truly outstanding returns with incredibly low levels of volatility.
So I'm going to leave you with this to think about. This isn't just a bunch of theory, it's a real framework you can use. So I want you to ask yourself, patience and quality. If you really committed to those 2 simple ideas, how could they fundamentally change your financial future? Thanks for joining me.
All right, let's get right into it. You know, a lot of us, even when we're doing well in our careers, have a financial life that's, well, a bit of a mess. It's not really a plan, is it? It's more like a collection of things we've bought over the years. If that sounds even a little bit familiar, then you are in exactly the right place. Today, we're going to walk through how to build a real, powerful blueprint for your future using a fascinating case study. So let's dive in. You know, everything we're about to talk about really boils down to this one simple but brilliant idea from the legendary John Bogle: risk, return, and cost. I want you to burn those 3 words into your mind. They are the 3 legs of the stool. If you get one of them wrong, the whole thing just falls over. We're going to see this eternal triangle play out again and again today. So let's meet our case study for today, a gentleman we'll call Mr. Talwar. He's 50 years old, he's had a successful career, and he thought he was doing all the right things with his money. But when he took a hard look, he found this huge gap between where his money was and where he wanted to go in life. And his story is just so powerful because, honestly, his situation is one I see all the time. So here's our roadmap. We're going to follow his journey step by step. We start with the wake-up call, that moment he realized something was wrong. Then we'll see how he turned those big, fuzzy dreams into a concrete plan. After that, we get to the fun part, building the 2 key components of his portfolio, the equity engine for growth and the debt portfolio for stability. We'll also talk about the silent killer of returns, fees. And finally, we'll reveal the finished blueprint that you can actually use as a model. Okay, first things first, the wake-up call. As we go through Mr. Talwar's initial portfolio, I want you to ask yourself a question. Do you know, really know, what your own portfolio is designed to do?
And, wow, just take a look at this. This is where he started. A whopping 77% of his entire net worth was locked up in real estate. Now, this is a super common pattern, but let me tell you, it's a trap. It's illiquid, which is just a fancy way of saying you can't get your hands on the cash when you need it. And it meant only a tiny 7% of his wealth was in financial assets that could actually grow and pay for his future.
See, the problem with a portfolio that's just sitting there is that it's fighting 2 invisible enemies every single day: time and inflation. And there's a great analogy for this. Think about carbon and oxygen. Separately, they're harmless, but when they combine, they create toxic carbon monoxide. It's the exact same thing here. Time plus inflation creates this silent toxic force that just eats away at the value of your money.
And this number, this is the real shocker. To actually achieve all of his goals, his kids' college, their weddings, family vacations, a new car, his portfolio, as it was, needed to generate a 21% return every single year. I mean, just think about that. 21% consistently. That's not just a long shot. It's practically fantasy. It was the clearest sign of all that the current plan was completely broken.
And that realization leads us to maybe the most important step in this whole process: turning vague dreams into a real, actionable plan. This is where you stop wishing and start planning. So the very first thing they did was organize his goals into these 3 buckets. It's a really powerful exercise. Security goals, like his kids' education, those are the absolute non-negotiables. Stability goals are about maintaining his lifestyle. And then you have ambitions, the nice-to-haves, like fancy cars and big trips. This simple act of sorting things out forces you to get honest about what truly matters. It separates your must-haves from your maybe-laters. And look at the immediate impact of that clarity. Mr. Talwar had to make some tough calls. He decided against a holiday home, pushed back the timeline for a new car. But look at the result of those trade-offs. His required rate of return plummeted from that impossible 21% all the way down to a much more realistic 16%. Now, that's a number we can actually work with.
All right, so the big question is, how on earth do you build a portfolio that can generate 16%? Well, you need a serious growth engine. And that's where equities come in. This is the core of the strategy, making up a full 80% of his new revitalized portfolio.
Now, that 80% in equity isn't just thrown into one stock. It's a carefully diversified machine. You've got the large cap Nifty ETF as the steady, stable base, then a coffee can portfolio of high-quality, consistent compounders. And then, for the real growth kick, you have the small cap portion, which is split between some good mutual funds and a very specific disciplined stock picking method.
Yeah, small caps can feel like the Wild West, which is why you absolutely need a framework like this. The good and clean approach is pretty straightforward. First, the good filter looks for businesses that are just fantastic at what they do, consistently making money for their shareholders. But then, and this is so important, the clean filter comes in and kicks out any company that has shady accounting or bad management. It's all about finding those hidden gems while making sure you avoid the blowups. So that's the 80% growth engine. What about the other 20%? Well, that's the debt portfolio. If you think about it in cricket terms, equity is your star batsman, hitting the 4s and 6s. Debt is the solid, reliable non-striker. His job isn't to score fast. His job is to protect the wicket, to provide stability, and to make sure you don't lose the match.
So the whole game here is picking the right kind of debt. Most people, like Mr. Talwar, just default to fixed deposits. But the smarter choice is almost always debt mutual funds. Why? It's all about taxes. With a debt fund, you get something called indexation benefits. All that really means is the government lets you adjust your profit for inflation before you pay tax on it. So you're only paying tax on your real returns, which can make a massive difference to what you actually keep.
Now, this is a question I get all the time. It makes sense, right? You look at a list of debt funds and you see one that's giving a higher return than the others. Why wouldn't you just pick that one? Isn't more return always better? Well, because it's a total trap. Chasing that extra 1% in your debt portfolio, that's like telling your solid non-striker to start swinging for the fences. You're asking him to do a job he wasn't designed for. You are in the debt portion of your portfolio for one reason and one reason only: safety. Higher yields almost always means the fund is taking more risk by lending to less reliable borrowers. That completely defeats the whole purpose. So we've talked about return and we've talked about risk. Now we have to talk about that third side of Bogle's triangle: cost. This section is so critical because fees are the silent killer of your wealth. They're like termites, slowly eating away at your returns over time. A 1% fee doesn't sound like a big deal, does it? But the effect of compounding makes it absolutely enormous. Look at this. If Mr. Talwar had used high-cost funds instead of low-cost ETFs and direct plans, his overall return would have dropped from 16.6% to 15.6%. That single percentage point, year after year after year, adds up to a staggering amount of money he would have just handed over to a fund manager instead of keeping for himself. So, we've redefined the goals, we've built the growth engine, we've added the stabilizer, and we've slashed the costs. So what does the final product look like? It's time to reveal the finished financial blueprint. And there it is, the after picture. It's clean, it's logical. You can see the 4 equal slices of the equity engine, each with a specific job, and the solid 20% debt foundation. And when you look at the math, the weighted average of all these expected returns brings him to that magic number, 16.6%. This is no longer a messy collection of investments. This is a portfolio built with intention and purpose. So what can we all learn from Mr. Talwar's story? It really just comes down to 3 timeless rules. Number 1, we have to have a plan. Figure out what you want out of life so you know what you need your money to do. Number 2, become obsessed with minimizing costs. It is the single easiest way to boost your long-term returns. And number 3, be patient. Buy quality and then just give it time to do its thing. Compounding is a marathon, not a sprint. So I'll just leave you with this one final question to think about. Your portfolio isn't just a statement with numbers on it. It is a tool. It's the tool you're using to build the life you want for yourself and your family. So, is your tool actually built for the job? Hello and welcome. We all have that picture in our head of what a good financial future looks like, right? A comfortable retirement, great opportunities for our kids, not having to worry about money. But how do you actually get from here to there? Well, today we're going to build that bridge. We're going to turn that dream into a real step-by-step financial plan. You really can't argue with Michael Jordan, can you? And this quote, it just perfectly captures the shift in thinking we need when it comes to our finances. This isn't a spectator sport. You can't just sit on the sidelines and wish you'll win. You've got to be the one on the court with a game plan ready to actually make it happen. So, how do we make it happen? How do we build that bridge? The answer is a solid financial plan. Seriously, think of it like your own personal roadmap. It's the thing that turns a vague destination, I want to be rich someday, into a clear turn-by-turn route. Without it, you're pretty much just driving in the dark and hoping you end up somewhere nice. To make this all as real and as practical as possible, we're going to skip the abstract theory. Instead, we're going to walk through a detailed, real-world example. So let's meet our guide for this journey, a gentleman named Mr. Kumar. By watching how he builds his plan right from scratch, you'll get a really clear blueprint to start thinking about your own.
Okay, this simple table here tells a huge story. Just look at the timeline. Mr. Kumar is 30 years old, and he's planning to work until he's 60. Those are his earning years. But his financial plan needs to support him all the way until he's 85. Those are his living years. Now let that sink in for a second. He has just 30 years of work to save up enough money to fund 55 years of his life. That single reality right there, it sets the stage for everything else we're about to do.
So where do we even begin? Well, the absolute first step, the foundation of everything, is getting a crystal clear picture of your cash flow. You have to know exactly what's coming in every month and what's going out. It's not the most glamorous part of the process, I'll admit, but trust me, it is the most important. First up, let's look at the income side. Mr. Kumar brings home 36 lakh rupees a year. Now, the key phrase there is post-tax. This is the actual money that hits his bank account after the government takes its share. Planning with your pre-tax or gross salary is such a common mistake, and it gives you a totally false sense of what you have to work with. Always, always plan with the real money you have. And now for the other side of the equation, his expenses. Mr. Kumar's total monthly outflow is about 1.82 lakh rupees. And right here, this is the fundamental challenge of any financial plan. One day, his income is going to stop. But these expenses, they don't stop. They keep on coming, month after month, year after year, and they'll probably grow with inflation. That is the core problem we are trying to solve. A pretty big chunk of his monthly expenses are these two loans, a home loan and a car loan. These are fixed liabilities. They have set timelines, and they are a completely non-negotiable part of his monthly cash outflow. They have to be paid, simple as that, so they have to be in the plan.
Okay, so we've got a really clear picture of his cash flow now. The next logical step is to take an inventory of what Mr. Kumar already owns. We need a snapshot of all his current assets to figure out what our starting point is.
Now, before we just start listing a bunch of stuff, let's use a really helpful framework. I want you to think about your assets as fitting into 3 different buckets. First, you've got personal assets. These are things you use, like your house or your car. Second, you have market assets. These are your investments meant for growth, things like stocks and mutual funds. And third, aspirational assets. These are your high-risk, high-reward bets. Just thinking this way brings a ton of clarity to your own portfolio. And here is that exact framework in action with Mr. Kumar's portfolio. You can see his house and his gold are sorted into the personal bucket. His mutual funds and stocks, well, they fall under market assets. And it's interesting to note he doesn't have any of those high-risk aspirational assets just yet. Laying it all out like this gives us a perfect, clear picture of his current net worth. All right, now we get to the heart of this whole thing, the why. Because honestly, a financial plan without goals is just a boring spreadsheet. Your goals are what give all these numbers meaning and direction. This is where you actually define what you're working so hard for. And just like we did with assets, it's really powerful to categorize your goals. The best way is to think of it as a pyramid. The base, the foundation, is security. These are the absolute must-haves. The middle layer is stability. This is all about your desired lifestyle. And the very top is ambition, your big dreams. This structure is so critical because if it turns out your plan needs an unrealistic return, you know you have to start trimming from the top, not from the bottom.
So at the very foundation of Mr. Kumar's pyramid, we find his security goals, making sure his children get a great education and ensuring his own retirement is comfortable. These are the absolute non-negotiables. You can think of them as promises he's making to his family and to his future self. The entire plan has to be built to make sure these happen, above everything else.
Moving one level up the pyramid, we have his stability goals. A new car in a few years, regular family vacations. These are about lifestyle and comfort. They're really important for a happy life, of course, but they have a little bit of flexibility in their timing or maybe their cost if adjustments are needed. And at the very peak of the pyramid, we find his ambition goal, buying a second home to generate some rental income. Now, this is a fantastic aspiration, but it's the goal he'd have to be willing to postpone or maybe alter if the final numbers show that reaching for it would mean taking on way too much risk.
All right, we've gathered all the pieces of the puzzle. We have the timeline, the cash flow, the assets, and all the goals nicely prioritized. Now, it's time to put them all together and see what the final picture actually looks like.
You know, after all this data entry and, let's be honest, a little bit of soul-searching, the entire complex financial life of Mr. Kumar can be boiled down to a single, incredibly powerful number. This one number is the ultimate reality check. It's the number that tells him exactly what it's going to take to make all his dreams come true.
And here it is, 13.3%. This single number is the answer. It is the required post-tax rate of return that Mr. Kumar's entire investment portfolio has to generate consistently year after year to fund every single one of his goals. Now, just take a moment to think about that. 13.3% after tax. That's not a small number. So the crucial question becomes, is it even achievable without taking on terrifying levels of risk?
The answer is yes. It's considered achievable, but it requires a very specific and diversified strategy. This isn't just a random collection of investments. Let's break it down. 35% is in debt mutual funds. That's for stability and lower risk. 25% is in broad market ETFs, exchange-traded funds, for diversified, steady growth. And then you see two very specific equity strategies. 20% in what's called a coffee can portfolio, which is all about buying and holding high-quality stocks for the long term. And another 20% in a good and clean portfolio, which likely focuses on companies with solid corporate governance. This balanced mix of safety and targeted growth is exactly what's designed to hit that 13.3% return. This is the how that makes the whole plan work.
And one final, absolutely vital piece of advice. This plan we've built for Mr. Kumar, it isn't set in stone. It's a living, breathing document. If he gets a big promotion, if his goals change, if he has another child, the plan has to be revisited and adjusted. Financial planning is a dynamic process, not a one-time thing you do and then forget about.
So there you have it, a complete financial plan, all the way from a blank page to a clear, actionable strategy. You've seen the process, you understand the different parts, you now have the map. The only question left is the one that really matters. What's your first step?
All right, let's talk about an investment strategy that honestly feels kind of radical today. It's a method that's all about cutting through the nonstop market chatter, and it's built on the discipline of doing, well, pretty much nothing. It's called coffee can investing. And you know what? It might just change how you think about building wealth for the long haul.
But first, let's just set the stage here with a problem I'm sure every single one of us has felt. As a modern investor, you are just constantly getting hit from all sides with information, right? You've got stock tickers updating by the second, so-called experts on TV, breaking news, and it's all screaming for you to do something right now. It's exhausting.
Sound familiar? You're watching the market bounce around like a yo-yo, day in and day out. There's that fear of missing out, that FOMO on the next big stock, but it's mixed with this absolute terror of a market crash. All that pressure, it makes us want to tinker with our portfolios, to trade too much, and let's be honest, it often leads to some pretty bad emotional decisions that end up costing us money.
Okay, but what if there was an antidote to all that chaos? A way to just step aside from it all? Well, that's exactly where the coffee cane portfolio comes in. It's this really elegant, simple idea that's all about choosing patience over panic and focusing on long-term quality instead of chasing short-term fads.
So what is this thing exactly? Well, a coffee can portfolio is basically a strategy where you buy a carefully selected group of great stocks and then, and this is the key part, you just leave them alone for a long time. We're talking 10 years. The name itself is pretty cool. It comes from the old American West, way before banks were on every corner. People would take their most valuable stuff, cash, gold, you name it, stick it in an old coffee can, and bury it in the backyard. They would literally put it away and forget about it. That's the whole philosophy right there.
Now, the beauty of this strategy is that its rules for picking these companies are so simple and so strict. There are really just two things you're looking for. First, you need companies that have grown their sales by at least 10% every single year for the last decade. No off years allowed. Then, from that already elite group, you filter it down again. You're looking for companies that have also maintained a return on capital employed, or ROCE, of at least 15%, again, for every single one of those 10 years. Just think of ROCE as a simple grade for how good a company is at turning money it invests back into profits. This double filter, it's designed to find businesses that aren't just growing, but are also incredibly efficient and profitable.
And that brings us to the most important part. Once you've built this portfolio, the heavy lifting is done. The next step, and I'd argue it's the hardest part, is to do absolutely nothing. You've got to fight every instinct that tells you to sell a stock that's down or take profits on a winner. You just lock it away, metaphorically speaking, and you let it be for a decade. This buy and forget idea is what really makes this strategy stand out.
Okay, I know what you're thinking. This all sounds great in theory, but does it actually work in the real world? Well, this is where the story gets really, really interesting. This strategy has been backtested like crazy, and the results, they're pretty mind-blowing. Let's dig into the proof. What you're seeing here, this is the headline. Over a 17-year stretch, they created and tracked 17 different coffee can portfolios, and every single one of them, 17 out of 17, beat the market. Not most of them, not the majority of them, all of them.
Let's break that down just a bit. This study focused on the Indian market, and what they did was build a brand new coffee can portfolio every single year. So over time, that gave them 17 different portfolios to track. 8 of them had finished their full 10-year journey, and another 9 were still in progress when they ran the numbers. And it didn't matter. Whether they were complete or not, every last one of them did better than the market benchmark, which in this case was the Sensex Total Shareholder Return Index.
And just look at this chart. This really shows you the scale of the outperformance. On average, the Finnish coffee can portfolios delivered an annual return of around 24%. The broader market, about 16%. Now, that difference, that alpha, might not sound like a huge number, but because of the magic of compounding, a gap like that year after year for a decade, it doesn't just give you a slightly better result. It leads to a profoundly, unbelievably different outcome in your final account balance. And of course, you might think, well, this must be because of some risky small-cap stocks. So they stress-tested it. They ran the numbers again, but this time they only used the big, large-cap companies that passed the filters. The result? It was the same. Even the more conservative, large-cap version of the coffee can portfolio beat the market every single time. That really tells you how solid these core ideas are. So the proof is pretty overwhelming that it works. But the million-dollar question is, why? How on earth can a strategy of just sitting on your hands consistently beat a market that's filled with some of the smartest, most active people in the world? Well, the answer comes down to 4 really powerful principles.
The power of this thing comes from a few ideas that work together perfectly. First, time is your greatest ally. History shows that if you hold a diversified basket of stocks for 10 years, your chances of making money get very, very close to 100%. You're just playing the odds. Second, winners dominate. And we're going to dive into this one more because it's huge. But basically, your biggest winners will grow so massive they'll make your losers irrelevant. Third, you eliminate all the noise. By just not trading, you make yourself immune to freaking out over scary headlines or getting sucked into the latest hype. And finally, you keep your costs super low. Every time you buy or sell, it costs you money. By basically never trading, you stop those fees from slowly eating away all your profits.
Okay, that idea of winners dominating, that is the most powerful and honestly, the least obvious part of this whole thing. So to really get it, let's stop talking in hypotheticals and actually crack open a real portfolio to see how this works in practice. So we're going to jump in our time machine and go back to 2004. We're going to look at the coffee can portfolio that was built that year and then held all the way to 2014. This one is the perfect case study to show you the wild range of returns you can expect and why that's not just okay, it's actually the secret to its success. Okay, take a good look at this table. In 2004, this portfolio put an equal amount of money into 10 different companies.
Now, if you just look at the bottom line, the whole portfolio turned 1,000 rupees into almost 17,000. That's a mind-boggling 32.7% annual return that just destroyed the market's 19.8%. But now look at the individual stocks. The performance is completely all over the place. The real story here is at the very top and the very bottom of this list.
And this slide just drives the point home perfectly. It's wild. On one side, you've got Havells India. A 100 rupee investment exploded. It turned into almost 9,000 rupees. That's a true monster stock. But on the other side, you've got Alloc Industries, which was an absolute train wreck. Your 100 rupees there just shriveled up, becoming only 29 rupees, a 70% loss. Now, your normal instinct would have been to sell Alloc years ago to cut your losses, right?
And here it is. This is the secret sauce. The math of investing is not symmetrical. The absolute most you can ever lose on a stock is 100% of what you put in. In this case, 100 rupees. But your potential gain? It's literally unlimited. The huge, almost 9,000 rupee gain from that one single winner, Havells, completely wiped out the 71 rupee loss from Alloc. Your job as a coffee can investor isn't to try and pick only winners. It's just to make sure you hold on long enough to get the full, incredible benefit from the few that go to the moon.
And just so we're clear, this pattern isn't a fluke. It's the norm. When you look across all the portfolios they tested, this is what you see. A typical portfolio has 2 or 3 stocks that do incredibly well, like Havells. It also has 2 or 3 that do really, really poorly. And then the rest just kind of muddle along, doing okay. The entire strategy is designed to let those few superstars carry the whole team to a massive victory.
So, as we start to land the plane here, what's the one big idea you should walk away with? What's the core lesson from all this data and the success of the coffee can strategy?
It really comes down to this. Amazing, market-crushing returns don't necessarily come from being smarter, having more data, or trading faster than everyone else. According to this evidence, they come from 2 things: a really simple process to find great businesses, and then the incredible discipline to just get out of your own way and let those businesses do their thing for a very long time. It turns out that sometimes the most powerful move you can make is to not move at all. And that leaves us with one final thought. In a world that's obsessed with speed, with action, with always being on, could it be that your greatest competitive advantage as an investor is something much quieter, much simpler, and a whole lot harder to master? Could it be that your greatest edge is just patience? All right, let's talk about one of the most famous and maybe one of the most dangerous numbers in investing, the PE ratio. We all know it, right? It's supposed to be this super simple tool for spotting a bargain. But what if I told you that for most investors, it's not a shortcut, it's a trap? So let's just start with the big question that pretty much every investor asks. You're scanning stocks, and you see a company with a PE of, say, 10, and its competitors are all trading at 20, 30, even 40. I mean, your first instinct is to yell, bargain, right? But is it really that simple? Well, the simple answer? No, it's not. Look, for the average investor who's just using PE as a quick shortcut, that low number isn't a sign of some hidden gem. More often than not, it's a red flag. It's a signal that the business might actually deserve to be cheap. And leaning on that one number, well, that's a dangerous game.
You know, we're all taught these little rules of thumb, aren't we? Just look at its PE compared to the last 5 years. Or, oh, check out the PEG ratio. It's got to be under 1. But here's the problem. All of these tricks anchor us to the past. They tell us a story about where the company has been, but they tell us absolutely nothing about where it's going. Okay, so here's how we're going to break this down. First, we'll start with a tale of 2 companies. Then we'll learn to follow the real money, the free cash. We'll uncover the true drivers of value, figure out how a super high PE can actually make sense, and wrap it all up with a whole new mindset for investing. So let's jump right in with a little puzzle. It's a simple comparison, but it gets right to the heart of why the PE ratio can be so misleading. Okay, so meet Company X and Company Y. On the surface, they look like identical twins. Same revenue, same projected growth, same profit margin. I mean, they're exactly the same on paper. So just looking at this, which one would you pick? Is there any reason at all to choose one over the other? It kind of feels like a trick question, right? Because from where we're standing, they're mirror images of each other. But now we pull back the curtain, and you see there's a huge difference hiding under the hood.
It's all about how much cash each company has to reinvest just to get that 5% growth. Company X has to pump half its earnings back in, while Company Y is so efficient it only needs a quarter. And that, my friends, changes everything. Just look at that last line, free cash flow.
And this leads us to the big reveal. You see, the real secret to valuing a business isn't in the earnings report, it's in the cash. You gotta learn to follow the free cash.
Now, this term, free cash flow, is absolutely crucial. Forget all the accounting jargon, just think of it like this. It's the actual cold, hard cash left over at the end of the year that the owners could literally take out of the business and put in their pockets without hurting its future. It's what's left after you pay for growth.
And this quote just nails it, doesn't it? Earnings are a nice story, but they're not the whole story. They show you the result, but they completely hide the cost of getting there. Free cash flow tells you both. So look what happens when we value these companies based on the actual cash they spin off. It's not even a contest. Company Y, the one that grows more efficiently, is worth 50% more than Company X. Suddenly, these identical twins don't look so identical after all. One is clearly the superior business. And here, right here, is the trap in all its glory. If these companies were priced correctly in the market, Company X would have a nice, low PE of 5. Company Y would have a higher one at 7.5. The novice investor, using those old shortcuts, would see the PE of 5 and think they'd found a steal. And they'd be dead wrong, choosing the worst business just because it looked cheaper.
So, this begs the question, what's the deeper lesson here? Why is Company Y so much better? It's not some kind of magic. It all comes down to two really powerful drivers of value that the PE ratio is completely blind to. The first one sounds a bit technical, marginal return on capital, but it's simple. It's just a measure of how good a company is at turning $1 into more dollars. Company Y invests $1 and gets 20 cents in profit back. Company X invests $1 and only gets 10 cents. Company Y is just a more efficient engine for growth, plain and simple. So that's driver number one, efficiency. But the second one is just as important, and that's durability. You see, it's one thing to be a great business for 1 year. It's another thing entirely to have a competitive advantage, a deep moat that lets you stay great for 10, 20 years. The PE ratio tells you nothing about efficiency, and it tells you nothing about durability. Okay, so this brings us to the really fun part, the climax. If a low PE doesn't mean cheap and a high PE doesn't necessarily mean expensive, then just how high can a PE go for a truly spectacular business? Let's run a little thought experiment. So let's imagine we find our dream company. We'll call it Company ABC. And let's say we're highly confident that this company can maintain an incredible 35% return on its capital for 20 straight years. And we'll also assume that eventually its star fades and its PE ratio slowly drifts down to the market average. Now, what's our goal as an investor? We're not trying to get rich quick. We're just trying to do as well as the overall stock market. Historically, that's been about an 11% return per year. Totally reasonable, right? So here it is, the million-dollar question. Knowing what we know about this superstar company, and with our modest goal of just matching the market, what is the absolute highest, most nosebleed PE multiple you could pay for it today and still hit that 11% return goal? What do you think? 50? 75? Maybe 100? The answer is absolutely mind-blowing. You could pay a PE of 210. Let me say that again. 210. And you would still make an 11% return per year for the next 2 decades. This one number just completely demolishes the idea that a high PE is always a bad thing. Okay, I know, 210 is an extreme theoretical number. But what about a more realistic scenario? What if you bought this amazing business at a PE of 50? A lot of people would scream that that's too expensive, but because the business itself is such a powerhouse, your annual return over those 20 years would be an amazing 19.5% a year. You'd absolutely crush the market. The whole point of this, the big takeaway, is that this requires us to completely change the way we think. We have to be willing to throw out those old, overly simple rules of thumb and adopt a new mindset that focuses on what actually drives value. So from now on, when you look at a stock, I want you to try something. I want you to stop asking, is this stock cheap? And instead ask a much tougher, but much more rewarding question. Is this business truly great? Does it have that incredible efficiency and that long-lasting durability to generate cash for decades to come? Because if the answer is yes, the price you pay today might matter a whole lot less than you think.
You know, every investor, and I mean every single one, eventually hits this exact same moment. It's a high-stakes question. You're looking at your portfolio, it's doing great, maybe even hitting all-time highs, and that little voice in your head starts whispering, is now the time to sell? Should I cash out before it all comes tumbling down? That temptation is just, it's huge. But is it the right move? Well, today, instead of just guessing, we are going to follow the data and find a real answer.
So here's how we're going to break this down. First, we'll dive right into that classic investor's dilemma. Then, we're going to put market timing to the test, and I mean really put it through its paces, with 3 different strategies. We'll look at selling high, then a smarter sell high, buy low approach, and of course, the fan favorite, buying the dip. After we see how they all stack up against just buying and holding, we're going to uncover the real reason why patience, well, why it almost always wins. Okay, so let's really paint the picture here. You've done your homework, you've invested in what you feel are some genuinely great companies, and guess what? It's working. Your portfolio is looking fantastic, but then you turn on the news and all you hear is talk about a frothy market, that valuations are stretched, and that urge to lock in your games, to just protect what you've built, it gets incredibly strong. It really feels like the smart thing to do. And that leads us right to this question, is this the moment? Is it time to pull the trigger, to sell everything and run to the safety of cash, just waiting for a better, cheaper time to get back in? I mean, it sounds perfectly logical. Sell high, buy low. That's the oldest rule in the book, right? But does it actually work in the real world? That's what we are here to find out. All right, for our first big experiment, we're going to test a really common market timing strategy. And listen, this is probably the most important part of our whole conversation today. We need to be super clear about the kind of portfolio we're talking about. The data we're looking at isn't about the S&P 500 or some broad market index. No, it's about a very specific strategy focused on owning exceptionally high-quality companies for the long run, what's sometimes called a coffee can portfolio. Think of it as a collection of the absolute best of the best businesses. So the real question is, even with these amazing companies, should you still try to sell them just because the wider market looks expensive? So to make this a fair test, we need some clear emotion-free rules. Here's the game plan. First, if the market's price-to-earnings ratio, which is just a common way to see if stocks are expensive, goes above 20, you sell. You sell everything, no questions asked. Second, you take that cash and you park it somewhere safe, like government bonds. Third, you have to wait 1 full year. And fourth, after that year is up, you only get back into the stock market if the PE has fallen back below that magic number of 20. It sounds like a pretty disciplined, logical plan. Okay, so what do you think happened? It sounds pretty smart, right? You're getting out when things seem pricey, you're protecting your capital, and you have a clear rule for getting back in. This has to be just sitting on your hands and doing nothing, doesn't it? Let's see what the numbers have to say. And boom, right out of the gate, we get a huge surprise. The data is just crystal clear on this one. This supposedly clever sell-high strategy, it just didn't work. The research showed that apart from a couple of tiny exceptions, the portfolios that tried to time the market simply could not beat the portfolios that just held on. The simple act of staying invested in those great companies through thick and thin delivered way better returns. That is a really powerful first result. Okay, so test 1 was a total bust. But maybe you're thinking, well, this strategy was just too simple. Maybe the problem wasn't selling when things got expensive. Maybe the problem was that our rule for getting back in wasn't tough enough. What if we get way more disciplined? What if we only get back into the market when it's not just less expensive, but genuinely cheap? Let's try that. So the rules for this second scenario are much more strict. The sell signal is exactly the same. PE goes above 20, you're out. And you still park your money in safe government bonds. But here's the game changer. You don't just wait a year. No, you wait patiently for as long as it takes for the market's PE to fall all the way down below 14. This is a true buy low discipline. You're waiting for what looks like a real bargain before you put a single dollar back to work. Now this feels a lot smarter, doesn't it? We're being more patient, more selective. We're not just dodging the highs. We are actively hunting for the lows. This has got to be the secret sauce. So, did this much more disciplined approach finally crush the simple buy and hold strategy? And this is where things get really interesting, and you start to see just how tricky market timing is. The results here were a little more mixed, but the final verdict is pretty much the same. Yeah, for some of the really old portfolios from way back, this strategy did show a tiny bit of outperformance. But, and this is a really big but, for more recent investors, it underperformed by a lot. The danger of sitting on the sidelines waiting for that perfect moment to buy meant missing out on huge gains.
Once again, the simpler, more reliable buy and hold strategy came out on top. All right, so trying to time our way out of the market seems like a losing game, at least with these kinds of high-quality stocks. But what about timing our way in? Maybe the real mistake is selling in the first place. So let's flip this whole thing on its head. Let's just hold on to our core stocks, but when the market gets cheap, that's our signal to invest more money. Everybody loves to talk about buying the dip, so let's see if it actually works. And the analysis here was super thorough. They actually tested 3 different ways to buy the dip. The first one was to switch into a completely new portfolio of great companies when the market dipped. The second was to double down on your existing stocks, but just add the new money equally to each one. And the third was similar, but you add the new cash in proportion to what you already own. So 3 pretty logical ways to try and take advantage of a down market. And here it is, maybe the biggest shock of all. Even these proactive strategies, which just feels so right, so intuitive, fail to create any extra return. Doubling down when the market looks cheap, no matter how you did it, did not beat the person who just bought their portfolio and then did absolutely nothing else. I mean, the data is starting to scream a very, very clear message at us. So now it's time. Let's step back and look at what all 5 of these tests are telling us. We looked at a simple sell high plan, a more sophisticated sell high buy low plan, and 3 different ways of buying the dip. We've thrown multiple logical timing strategies at this problem. So what is the final verdict? The conclusion is just inescapable. In this incredibly detailed analysis, looking at it from 5 different angles, the complex, stressful act of trying to time the market was basically a waste of time. It failed to consistently beat the simple, patient, and maybe kind of boring strategy of just buying great companies and holding on for the ride. All that effort, all that anxiety, it was all for nothing. And this is where we have to ask the single most important question. Why? Why does this happen? It feels so wrong, so counterintuitive. Buy low, sell high is supposed to be the golden rule of investing. Why did it fail so badly in every single one of these tests? Well, like we hinted at before, the answer isn't about timing the market. It's about the nature of the stocks themselves. And that brings us to the final and most crucial piece of this entire puzzle. The reason patience pays off so well here has everything to do with the kind of companies we're talking about. The whole thing hinges on the unique power of the businesses you'd find inside one of these coffee can portfolios. So let's just revisit this idea because it really is the key that unlocks this whole mystery. The coffee can portfolio gets its name from the old days in the American West, where folks would put their valuables, gold, deeds, whatever, in a coffee can and just bury it for years. The investing idea is the same. You buy a portfolio of exceptionally high-quality companies, businesses with bulletproof financials and durable advantages over their competition, and then you just leave it alone for a very, very long time. And this quote right here says it all. The truly great companies, the ones that consistently grow and generate fantastic returns, they often look expensive if you just look at the standard numbers. Why? Because the market knows they're great. It rewards their quality with a higher price tag. So if your strategy is to automatically sell every time the market's PE ratio looks a bit high, you are systematically kicking your best players off the team, often right when they're about to score big. So what's the bottom line here for you and me? First, if you own genuinely high-quality companies, trying to dance in and out of the market is far more likely to hurt you than help you. Second, using a big, broad market number like the overall PE ratio to decide whether to sell a specific, amazing business can be a massive mistake. And finally, the real magic, the secret to this kind of wealth creation, comes from patience. It comes from just letting the incredible power of compounding do its thing inside these superior businesses over years and decades. And that really just leaves us with one final thought to ponder. Take a hard look at your own investments, at your own strategy. Are you always trying to guess the perfect moment to get in or get out? Or have you built a collection of businesses that you truly believe in for the long haul? Ask yourself, is your portfolio built for the frantic activity of timing, or is it built for the quiet, patient power of time? Because the data we've looked at today suggests one of those paths is a whole lot more rewarding than the other.
You know, every investor has to ask themselves this question at some point. When the inevitable market storm hits, is my portfolio really built to last? We're not just talking about surviving, but actually thriving through the chaos. Today, we're going to dig into a powerful, time-tested strategy that's designed to do exactly that. Let's get into it.
Leave it to Warren Buffett to put it so perfectly, right? This quote just cuts through all the noise. When the market is booming, pretty much any strategy can look genius, but the real test, well, that comes when the tide of easy money goes out. That's when you really see which strategies were built on solid ground and which ones, well, weren't.
And that really brings us to the big question for all of us, because it's never a matter of if the tide will go out. It's only a matter of when. So how do you prepare? How do you put together a portfolio that isn't just there for the good times, but one that you can actually count on when things get rough?
Well, the answer we're looking at today has this wonderfully simple, almost old-fashioned name, the coffee can portfolio. The idea is brilliant in its simplicity. You buy shares in truly excellent, durable companies, and then you metaphorically stick them in a coffee can and just forget about them for a decade or more. It's all about quality over quantity and completely resisting that temptation to constantly tinker and trade.
So here's what we've got on tap. First, we're going to see what really happens when that tide goes out by putting the coffee can portfolio right up against the broader market. Then, we'll zoom in on the companies themselves to see a pretty amazing story of consistency. After that, we'll get under the hood and look at the engine that drives this resilience. And finally, we'll wrap it all up with the key takeaways for you.
All right, let's jump straight to the evidence. We'll start with the big picture, the macro proof. How does this coffee can portfolio strategy actually perform against the market, especially when the going gets tough?
And right away, you see this really fascinating difference in behavior. When there's stress in the market, the broader index, like the Sensex, tends to take these really deep, painful dives. The coffee can portfolio, on the other hand, tends to fall a lot less. But what's just as important is the recovery. The CCP bounces back faster and stronger, often getting a head start while the rest of the market is still shaking off the hit.
So let's put some numbers to that. Picture a really nasty market crash, the kind where the broad index just gets sliced in half, a brutal 50% drop.
Now, in that exact same environment, a typical coffee can portfolio might only fall by about half that much, say 25%. Look, a loss is still a loss, but the difference between seeing your portfolio cut in half versus down by a quarter, that is just a massive, massive difference, not just financially, but psychologically too. That's the power of quality right there.
Now, let's be totally fair about this. It's not some magic trick that works every single time. There was one period, back in 2005 to 2007, where these portfolios actually underperformed the market. It was a time of, as the source calls it, irrational exuberance. But, and this is a huge but, even while they were technically underperforming a market that was on fire, these portfolios were still churning out fantastic absolute returns of 20–25%. They just weren't caught up in the speculative frenzy.
Okay, so we've seen the results at the portfolio level, but now let's get granular. Let's look at the micro proof, the individual companies themselves. I mean, where does this incredible strength actually come from?
So first, let's set our baseline. Let's look at the broader market. Over a 25-year stretch, the Sensex gave a positive return for the year in 15 of those years. So about 60% of the time, it was up. That means 40% of the time, it was down. Not bad, but still, you're looking at a pretty significant chunk of down years.
Okay, now compare that to a typical company you'd find in a coffee can portfolio. Instead of being in the green 60% of the time, these companies are delivering positive returns more like 85% of the time. I mean, that is just a whole different level of consistency, and that is the secret sauce we're talking about.
But hang on, this next stat is even more impressive. Just look at this number, 6 out of 10.
So what does that 6 out of 10 mean? Well, over that 25-year period, the market had 10 down years. During those 10 worst years for the market, the very best CCP-type companies still managed to post a positive return in 6 of them. Just let that sink in for a second. The entire market is going down the drain, and these incredibly strong businesses are still, more often than not, making money for their shareholders. That's just incredible resilience.
Okay, so we've seen the what. We know these portfolios are more resilient. But now for the really important part, the why. What's the actual financial engine at work here that lets these companies seemingly defy gravity when the rest of the market is in a free fall?
It really comes down to 2 main things. First, the earnings growth of these companies is just so consistently strong that it can literally overpower the fear and negativity in the market. And second, something really interesting happens. In scary times, investors often run towards quality, which can actually protect or even boost the valuation of these steady companies. Let's break that down.
This slide shows that first factor perfectly. Let's look at Asian Paints back in fiscal year 2009, a really rough year for the markets. You can see that general market fear caused its valuation multiple, its PE, to get knocked down by 16%. But here's the amazing part. Look at its earnings per share.
They actually grew by a whopping 17%. That fundamental business growth was so strong, it just completely steamrolled the market's negative sentiment, and the stock still ended up with a 10% gain.
Now for the second reason, which, to me, is even more interesting. Sometimes the market doesn't even punish these companies' valuations. Take a look at fiscal year 12. The broader market's valuation fell by 16%. But for Asian Paints, investors were looking for a safe place to hide. They saw it as a beacon of quality, and they rewarded it so much that its valuation multiple actually went up by 10%. That's what they call a flight to quality, and it's an incredibly powerful defense during a storm.
So, we've looked at the big picture, we've zoomed in on the details, and we've unpacked the engine driving it all. What's the final lesson here? What should we really walk away with after seeing all this?
Well, here are the big ones. First and foremost, quality is your best defense. Period. The strength of the actual business is what protects you. Second, consistency is so much more important than trying to time the market. Winning often, even if it's not a home run every time, is a much better plan. Third, you have to remember this is a long-term strategy. It's about buying great businesses and letting them do what they do best over many years. And finally, never ever forget that earnings are the engine. Over the long haul, a company's stock price will always follow its earnings growth. Which kind of leaves us with one final thought to chew on. You know, we live in a world that is just obsessed with timing the market, getting in at the perfect bottom, selling at the absolute top. But maybe, just maybe, all this evidence is pointing to a different secret. Maybe the real key isn't timing the market at all, but simply maximizing your time in the market, as long as you've filled it with the right companies. Something to think about. Thanks for tuning in.
You've heard it a million times, right? The number one rule of investing: buy low, sell high. It's like the first commandment of the stock market. But what if that whole idea is built on a shaky foundation? What if it's a myth? Well, today, that's exactly what we're going to dig into: the valuation myth.
Yeah, that whole buy low, sell high thing, it seems so simple. And for most people, that means one thing: you gotta hunt for those cheap stocks. You know, find the bargains that everyone else has overlooked. It feels so intuitive, doesn't it? But is that really how you win this game? Is buying cheap the actual secret to making it big in the stock market?
And right there, that's the big idea we're talking about. The belief that if a stock has a low valuation, it's almost a sure thing for high future returns. I mean, entire investment philosophies are built on this one single idea. So today, we are going to put that very belief to the test. We're going to see if it actually holds up. And look, we're not just going to sit here and talk about this in the abstract. Nope. We're diving headfirst into some serious data, a really detailed analysis that crunched the actual real-world numbers. It's time to find out if this hugely popular strategy has any teeth. Okay, so before we get into the results, let's make sure we're all on the same page with the lingo. The first big tool investors use to find cheap stocks is the PE ratio. That's price to earnings. It's super common. You just compare the stock's price to how much money the company is actually making. For ages, a low PE was like a flashing green light, a classic buy this now signal.
And the second big one is the P/B ratio, or price to book. This one's a little different. It compares the stock price to the company's book value, which is basically what the company's assets are worth on paper. But the logic is the same. Find a stock with a low P/B, and boom, you've supposedly found a bargain. These two, PE and PB, they're pretty much the foundation of what people call value investing.
Now here's what makes this analysis so cool. They didn't just look at one slice of time. They tested this buy cheap theory across 3 totally different environments. You can think of them as 3 battlegrounds. We've got a nervous, defensive market, then a crazy, optimistic bull market, and for the grand finale, the long haul, a full 10-year stretch that saw all kinds of ups and downs.
All right, let's jump into that first scenario, the defensive market. We're looking at the years 2012 through 2017. Now, during this time, people were, well, they were cautious, jittery. Everyone was playing it safe, piling into what they saw as high-quality, reliable companies. A classic flight to quality, as they say.
So here's the big question for this round. When everyone's playing defense, does being a bargain hunter actually pay off? You know, just scooping up stocks with those low PE or PB ratios give you any kind of advantage when the market is feeling skittish?
And the results? Well, they were crystal clear. Looking at both 3-year and 5-year returns, the data showed nothing. Absolutely no significant connection. A stock's starting PE or PB ratio had basically zero power to predict how it would perform down the line. It was a total wash.
So, the verdict for round one? Simple. No connection. In a defensive market, the buy cheap strategy just didn't work. Plain and simple.
Okay, you might be thinking, well, maybe that was just because it was a weird, cautious market. Fair enough. So let's head to battleground number 2, a roaring bull market. We're talking about 2003 to 2008. The economy was humming, everyone was optimistic, things were booming.
Now, this is where you'd expect the buy cheap strategy to really shine, right? I mean, when the whole market's on a rocket ship, getting it on a stock with a low valuation should be like hitting the afterburners. It ought to send your returns into orbit. Or so you'd think. And get ready for a surprise. Or maybe not, because the data from this huge bull market tells the exact same story. Again, whether you look at returns over 3 years or 5 years, there was no clear link between a low starting valuation and better performance. The only consistent pattern was that there was no pattern. So, the verdict for the bull market test? You guessed it, still no connection. We've looked at 2 completely different market types, and we've gotten the exact same result. You can see where this is going, right? The evidence is definitely starting to stack up. Which brings us to our final and honestly the most important test of all, the long view. This time the analysis covers a full decade, from 2007 all the way to 2017. And this period is critical because it had everything: the huge crash of the financial crisis, the long recovery, good times, bad times, you name it. This is the real stress test.
Yeah, this really is the ultimate test. Because the biggest fans of value investing always say the same thing. It's a long-term game. So if this strategy has any magic to it at all, it has got to show up over a full decade where all the short-term craziness gets smoothed out. So, did it? Did it finally pay off?
Well, I think this pretty much says it all. This is kind of the final nail in the coffin for the theory. Even after 10 years through all those crazy market swings, the result was exactly the same. The connection between a stock's starting valuation and its 10-year return was so small it was basically meaningless, statistically insignificant. In plain English, it just didn't matter. So let's wrap this up. We've tested this idea in a defensive market, we've tested it in a bull market, and we've tested it over the long haul. The final verdict is in. And that belief, that core idea that you can just find cheap stocks and automatically do better than everyone else, well, it looks like it's a myth. It's busted.
Okay, so where does that leave us? What's the big takeaway here for anyone trying to, invest smarter? If hunting for cheapness isn't the secret sauce, then what is? What should we be looking for?
You know what? Let's not even paraphrase it. Let's just go straight to the source. The analysis itself concluded, and I'm quoting here, there is no evidence to suggest that buying stocks which look cheap on PE or PB leads to superior investment returns in the long run. I mean, you can't get much more blunt than that, can you?
So, to recap everything we've looked at today, it turns out that a stock's starting valuation just isn't the crystal ball we all hoped it would be. It doesn't work in defensive markets, it doesn't work in bull markets, and it doesn't even work over 10 years. That old rule of thumb to just buy cheap, well, this data suggests it's a map that leads you nowhere special.
And that really leaves us with one huge, important question to think about. If obsessing over price, is it cheap, is it expensive, if that's the wrong conversation to be having, then what is the right one? What's the right question we should all be asking as investors? Something to think about. Thanks for joining me.
All right, let's talk about an investment idea that really turns everything you think you know on its head. It's called the coffee can portfolio, and it's all built around one kind of radical idea, that the best thing you can do to build wealth might be to do absolutely nothing. Sounds crazy, right? Well, let's dive in.
I mean, just think about that for a second. In a world that's constantly telling you to trade, to check the market, to react to every little piece of news, what if the real secret was to just stop? To just let it be? This is such a powerful and honestly a very counterintuitive idea, and it's exactly what we're going to unpack today.
So you might be asking, why do we even need a strategy that's so simple? Well, because for most of us, investing feels like trying to navigate this incredibly complicated maze. And let's be honest, a lot of the time it's actually designed that way on purpose. You know, there's a saying going around that it's actually harder to pick a good mutual fund these days than it is to pick a good stock.
And you can see why. We are just flooded with data, buried under all these complex rules, and we're getting bombarded with advice, and a lot of that advice has hidden motives. It's a system that makes it feel almost impossible to be confident about where you're putting your hard-earned money. A huge part of this problem is something called push products. Now, these are financial tools that are often sold to you, not bought by you. See the difference? They're designed to be confusing, and they come with these massive commissions for the person selling them. And the bottom line? They often end up helping the distributor way more than they help you, the investor. A classic example of this is the unit-linked insurance plan, or what we call a ULIP. Now, on the surface, it sounds pretty good. It mixes insurance and investment together. But when you look under the hood, they're often just loaded with high, hidden fees and commissions. It makes them so much more expensive than if you just bought a simple insurance plan and invested in a good, low-cost mutual fund separately. And the cost of all this complexity, man, it is just staggering. Look at this number, 1.5 lakh crore rupees. That's the estimated loss that Indian investors took because of these missold or lapsed ULIPs. We're talking about billions and billions of dollars in wealth that just, poof, vanished from people's savings. It's clear that we desperately need a simpler, safer way to do things. So if the modern financial world is so often the problem, where do we look for the solution? Well, sometimes the best ideas aren't new at all. To find this one, we've got to go back in time, way back, to the Old West. This quote comes from a guy named Robert Kirby. He was an investment manager back in the 80s, and he started noticing something really fascinating. His best-performing clients, the ones with the most incredible returns, were often the ones who had bought some stocks and then completely forgot about them for years. He called them his Rip Van Winkle investors. And this observation led him to this brilliant coffee can analogy. See, back in the Old West, before you had a bank on every corner, people would put their most valuable possessions, deeds, cash, even stock certificates, into a sturdy old coffee can, and they'd hide it away. They would literally buy something valuable and then just forget about it. And that simple act of just leaving their assets untouched was the key to both keeping them safe and letting them grow over a long, long time. Okay, so that's a really cool story from the past. But how in the world do we take that old school wisdom and apply it to today's crazy financial markets? Well, let's break down how you actually build a modern version of the coffee can portfolio. The modern approach has 3 really simple rules. First, you identify truly high-quality, top-notch companies. Second, you buy a diversified basket of about 10 to 15 of them. And third, and this is by far the hardest part, you do absolutely nothing. You hold onto that portfolio for at least 10 years. No selling, no trading, no tinkering. You just leave it alone. So what does a quality company even look like? Well, it's not about the latest hype. It's about extreme, boring consistency. The first filter is relentless sales growth. We're looking for companies that have grown their sales by at least 10% every single year for a decade straight. Not an average of 10%, mind you, but hitting that mark year in, year out. The second filter is a consistently high return on equity, which tells you the company is dominant and incredibly efficient. So what is this return on equity, or ROE? Well, think of it like this. For every single dollar that shareholders have invested in the company, how much profit can the management team squeeze out? A company with a consistently high ROE is a master at turning your investment into more money. It's one of the best signs of a really well-run quality business. Okay, so now we have the rules. But why does this do-nothing approach actually work so well, especially when it seems to go against every single instinct we have as investors? Let's really look at the proof behind the power of patience. Now, it's really important to get that this coffee can idea is completely different from other styles, like value investing, right? Value investors are always on the hunt for stocks that look cheap. But in a market like India's, for instance, cheap can be a real trap. It can hide bad accounting or bad management. The coffee can strategy just sidesteps that whole risk. It focuses only on proven, durable, high-quality companies, and then it just lets time do all the heavy lifting for you. And the results? Does it actually work? Well, historically, a portfolio built on these exact strict principles has on average beaten the broader market index by almost 12 percentage points per year. That is a massive, life-changing difference in your returns. And you get it not through frantic activity, but through disciplined inactivity.
So here's the secret sauce. Here's why this works. In any portfolio you build, some stocks are going to do okay. Some might even fail. But over a decade, one or two of your picks might become spectacular winners, growing 10, 20, maybe even 50 times their original value. By never selling, you give these champions the uninterrupted runway they need to just grow exponentially. They become the giants that carry the entire portfolio to incredible heights.
You know, at the end of the day, investing isn't just about numbers on a spreadsheet. It's really about funding the kind of life you want to live. So let's bring this all back to what truly matters.
This quote just nails it, doesn't it? We don't invest just to get a high score. We invest for a real purpose. For our kids' future, for a retirement where we don't have to worry, for the freedom to do what we love. The real goal isn't just beating the market. It's having the money we need to live the life we actually want.
And that, right there, is the ultimate promise of this whole strategy. Look, it's not some get-rich-quick scheme. It is a disciplined, lower-risk way to steadily and, most importantly, reliably build the wealth you need to fund your life's goals. You're basically trading the day-to-day stress of market watching for the quiet confidence of a solid long-term plan.
So I'll leave you with this final thought. Doing the research, picking the great companies, that's actually the easy part. That's a problem you can solve. The real challenge here is psychological. Once you've made your choices and you've put them in your proverbial coffee can, do you have the discipline, the temperament, the sheer courage to just leave it alone, to let that magic of compounding do its work uninterrupted for a decade? That's the real test.